without further ado, let me introduce our fantastic moderator, Anish Acharya. Anish joined A16Z as a general partner in 2019. A16Z, for those of you dialing in Canada, sometimes better known as Andreessen Horowitz. That's where he invests in fintech and adjacent technologies. Prior to his life as an investor, Anish was a multi-time founder and product executive, most recently at Credit Karma, which he joined with the acquisition of Snowball, a notification startup that he had founded a year prior. Anish is Canadian. He's originally from Kingston, and he's based in the Bay Area. He's a proud Waterloo alumnus. Anish, thank you so much for contributing to today's discussion and for helping us have a great conversation with our fintech founders. Over to you.
You're welcome, Laura. Thanks for having me. Excited to be here and see, I think, some familiar and friendly faces and some folks that I haven't met yet. But nice to see you all in this very, very strange time. So look, the one rule that Laura gave me was do not ask the panelists the same question. And I'm going to break that rule once and only once, I promise, by sort of asking each of them to give maybe a brief introduction for the company, but also talk a bit about their, what's their personal connection to it. And, we've often found that founders have these really interesting, authentic stories that drive the work that they do in their companies. And I'm sure everyone in the room would love to hear a bit more about that. So with that, maybe I'll start with Ollie.
Yeah, sure. Awesome. And thanks for hosting us on short notice, Anish. So I'm Ali Dhalla, CEO and co-founder here at Finaeo. Finaeo is a product and platform company focused on life and complex insurance distribution. On the one side, we help insurance companies digitize their products and take them downstream into market quickly. And on the other side, we give insurance brokers the toolkit to take their customer from prospect to policy. So a little bit about why my co-founder, who's here today, Donald Chu, and I started this business. We both started our careers as financial professionals serving families before we became entrepreneurs. And so kind of fast forward through to 2015, 2016, and you started to see the rise of the robo-advisor and the chatbot. And for me, this great technology that really should be used, but I know for a fact that it doesn't replace the type of dialogue that a family and a financial professional actually have that would traditionally be around a kitchen table or at an office. And so our hope and our desire is that we keep humans at the center point of financial services for as long as possible and empower everybody in the ecosystem to really have a beautiful experience that's not powered by fax machines and PDFs.
Fantastic. Great. Ian?
Hi, everyone. Thanks for being here today. Really excited to be part of this year's 48 Hours in the Valley. So born and raised in Montreal, and I actually grew up in a family of someone who was a senior executive in the life insurance world, and I never thought I'd be here working in that space, but here I am. So we are Breathe Life, and we built a distribution platform for life and annuity products, really focused on the distribution. And we sell our white label solution to carriers. We have clients across the US and Canada. And our purpose is really to make financial security accessible to as many people as possible. It's a product that delivers tremendous value in the lives of families. And my co-founder actually witnessed the power of life insurance as a child, having lost his father when he was 9 and having tremendous coverage in the family. So he was one of the lucky ones, one of the fortunate ones to at least not have a financial impact on the family. So he was able to go to private school and university and college and everything. And so really what we're trying to do is make that type of product available to as many people around the world as possible, focus mainly on the US and Canada right now. And we've been around for about 2.5 years now. And we announced our Series A over the course of the summer. And yeah, exactly. Really happy to be here and looking forward to this panel today.
Thanks for sharing that, Ian. And one thing I'd love to dive into with both you and Ali later is just sort of, is there an opportunity to expand the market for life insurance? It seems like most people should have it. Many people don't have it. Is the bigger opportunity in better addressing the market that life insurance serves today, or expanding the market, and how do we do that? But let's get into that in a moment. Femi, would love to hear from you. You and I spent some time together a couple of months ago, so excited for everyone else to get to know you.
Sure, appreciate it. So my name is Femi. I'm the CEO and co-founder of ScholarMe. Um, I started ScholarMe back when I was like 17, 18. It was like May of my senior year of high school. And I felt I had two life-ending questions to answer. First, how I was going to ask my friend Christine to go to prom with me. And then second, how I was going to pay a $60,000 tuition bill. I ended up realizing later that only one of those questions ultimately mattered in the long run, but I kind of ran into experience millions of students run into every single year where you're going from a world in which you had no ownership over your or autonomy over yourself, and now you're being asked to make the largest financial decision that you're going to make throughout pretty much your entire 20s. So we started out pretty much built ScholarMe in order to pay for my own college education, and what we do is allow students to automate 1,000 plus different financial aid applications with a single form. Ended up doing it so well for myself that by the time I later dropped out of school, after first semester, I had won so much aid that I got a refund check back from my college. And I dropped out to kind of thinking around like, what is like, didn't even know the word at the time, but pretty much like, what does Fintech for Gen Z look like? Right now, it's very fragmented, super difficult, and really opaque. And at ScholarMe, we're hoping across the board for every single financial product that a college student will ever need to touch, we make it really simple, really transparent, and really easy to understand, and allow them to do it all in one place. We've now grown to over 150,000 students, 50,000 students using the platform, and are excited for our growth over the next few months.
That's incredible. You know, looking at consumer fintech companies each and every day, I could tell you that 150,000 is a ton of consumers. Maybe Femi, talk a little bit about the urgency and how acute the pain point is, because I think for folks in Canada, it's not as intuitive as it may be if you went to college down here.
Yeah. When I came up to Toronto and saw OSAP, I was like, wow, this is exactly what we need in the States. Yeah, for like paying for college in the States, you're kind of being asked to piece together dozens of different applications over four main groups. You have government aid, you have 500 plus state aid programs, you have thousands of scholarships, you have a lot of institutional aid, and you kind of go through this wormhole of like trying to figure out how do I piece all of these things together while you're also going through a very stressful time in your senior year of high school. So the pain becomes like pretty acute as soon as you start applying to school, which is right now we've had a lot of growth in this past week because people are applying to college as we speak. And then it starts to become more and more acute as you go throughout the school year. And you're a few months ago, we had a student who said she got her tuition bill from her college, and she was like, I didn't realize college actually costs money. And so it becomes very acute at that point where you've worked for the last 4 years, studied a lot to be able to go to university, and you're really excited. And then the last hurdle you have to jump is $40,000-$50,000 tuition bill. And even the cost compared to schools in Canada is like 3-4x what you would pay there. So very painful.
Super interesting. And it does sort of speak to that awareness gap, right? When you're applying to university, to college down here, just not being aware of what are the options out there for financial aid and what are the things that you should be seeking. So Ian, Ollie, maybe you guys could speak to this in the life insurance context. You know, what's the thing that we're all supposed to be doing that we're not doing? And is that a solvable problem or not?
Do you want to jump in, Ali?
No, you go for it.
Yeah, I mean, I think it's definitely a problem that is worth tackling. You know, I like to say that it's incredibly difficult to sell life insurance, right? It's a product that is sold, not bought. It's sort of the old adage, but it's incredibly difficult to buy it as well, especially if you're starting out in life. And you know, it's this type of product that you can always postpone. Like every day that you're still alive is a day that, you know, you can buy the product or postpone it. And it's one of the most selfless gifts that you can purchase, right? You, as an individual who are purchasing a life product, will never reap the benefits of it, right? The best thing you'll ever get is the satisfaction that knowing that if something were to happen to you, your loved ones would be taken care of. And so being exposed to this for a very long time, I bought my first policy when I was very young. I was 24 years old. And that was when I bought my first house, which, is often the first trigger, or having a first child, or something like that. I think that the challenge that we have in the market is that the types of products that are being sold for that, or purchased by that type of consumer, are really not cost effective for the advisor who's selling those products. And therefore, the advisors are focused on selling to people that are much more mature in their life cycles, that are going to buy a much more complex product that will have a great commission for them. And that's fine. And I don't think that necessarily needs to change. But what I think we can do through technology is offer solutions for the people that are starting out in life, that need the product just as much as anyone else, to buy those products in the way that is either self-serve or through an advisor, but is cost effective for everyone involved, whether it's the carrier, the distribution organization, or the advisor, and doing that through technology. Because as Ali said, the majority of policies are still sold face-to-face at a kitchen table, and just take months to happen, and involve all kinds of different people that could be streamlined through technology. And I think we can certainly, through technology, increase the amount of policies that are sold, and really tackle that coverage gap, which is gigantic in the US. And so that's a big reason why we exist, beyond our purpose to protect people. But there's material room to build a big business in this space, for sure.
Got it.
Yeah.
Please, Ali.
I'll piggyback off of Ian, and I think, Ian, you brought up some really great points. I think this whole concept around sold, not bought. When we were doing customer discovery downstream, because I think a lot of the time it's like the root cause of a problem is actually not the problem. We got to go a couple of layers deeper. And a lot of consumers talked about their broker experience as to the same as buying a used car. So you're talking about an accredited professional who's being, no disrespect to those who sell cars, but like that's a different level of professional class than someone who sells you a car. And so I think that there's an image problem here. And this image problem has to get reframed, and it starts at how do we prepare and equip the people to do their job more effectively. And most of that cycle experience starts with education. And it starts with helping to equip both the broker, the customer, with the right information at the right time of the sale, or at the right time in the moment. And then it kind of removes one of the other problems in the industry, which is buyer's remorse. The average application that gets underwritten takes anywhere between 6 to 12 weeks. And in that process, a consumer can cancel that application at any time. And so you kind of end up in the situation where I've gone through the whole process as a broker. I've spent a lot of time and a lot of money of my own educating and servicing, just to have it washed away because the process is ineffective and inefficient. On the other hand, on the far side of the spectrum with insurance companies, they really struggle with taking net new products to market quickly. And this is a real challenge as we think about what the consumer need for Femi and his class of customers is going to be, which is personalization. And we really need to help insurance companies think differently about the speed and lack thereof. The average cycle time is 2 years from product ideation into market. And I know that companies like Breathe and Finaeo are working really hard to help our carrier partners almost kind of like get out of their own way, so we can help them solve that problem. And so along the value chain, Anish, there's just so many different problems to attack. And so we're lucky in that sense, but it's also a challenge because it's a big, big problem to take on.
I love that. And look, I think it's really great that there's so much need from the carrier. My question for you though, Ali, is, why partner with them and enable them versus compete with them? Because it seems like you not only have to solve a technology problem, you then have to solve a cultural problem within those organizations.
Sure. Yeah, it's a good question. And so I think this whole concept around are we a disruptor or are we an enabler in our industry is a really powerful question to ask. The one piece that I go back to is that if you want to keep humans centric in the fold, and in our business model, our choice was we didn't want to bear risk. To be a non-risk bearing distribution platform, you got to partner with the supply side. And to partner with the supply side, one of the challenges that I don't want to create is channel conflict. So I don't want to sell direct to customer, and I don't want to be competing with them on manufacturing. Where I want to help them is to help them create downstream differentiation and process automation, and to create that customized workflow for brokers. The core problem that the industry has downstream, there's no unification of an application. It's never existed. And I think we finally kind of cracked that problem, which is a huge, huge bottleneck to the industry. And so it will effectively equip the entire industry to grow their pie, because we're, I think, going to enable more sales velocity downstream.
Got it. And then Ian, do you think that this unlocks the ability for sort of new carriers to be started? I did a little bit of research, and it seems like a lot of the Fortune 500 life insurance carriers were started pre-World War II. With that, is that going to change, or are we really in the business of sort of partnering with these very old school companies?
Well, I think there's definitely opportunities for that to happen. And what we're seeing in our discussions is those who are starting up new companies are mostly focused on trying to go direct, right? And so, they're not necessarily trying to disintermediate the producers or the advisors, but really going with a direct approach first, with a type of omni-channel experience, right? So they're saying, hey, right now 90% of policies are sold with some form of human intervention. But the industry seems to believe that 10% is going to grow over time as consumers continue to demand more modern experiences. And they're buying houses online, they're buying everything online. Why not life? And so there are a handful of carriers that we're talking to and working with, where they're launching a separate brand of direct focus. So really trying to enable the consumer first, as a way to protect themselves a bit around that channel conflict that Ali was mentioning, right? Because they don't want to get the industry angry at them and sort of saying, hey, we're going to do this new thing on the side here, call it XYZ, brand it something different, focus on direct, see if it works, and over time expand that and put more and more energy around that as the market changes and grows. Like, we certainly believe that more and more consumers will buy direct over time. It's a long-term play, but the human intervention will always remain a very important part of it. And if we can provide that human, right, whether it's someone in a call center or even someone face-to-face at that kitchen table with more modern technology, that ultimately delivers a better experience for everyone, whether the buyer or the seller, then we think that there's a big opportunity there. And we don't think the human being's going away anytime soon. It's not the type of product that you can 100% of the time buy self-serve, right? You want to have that help from someone you trust and someone you believe in.
Yeah, that makes sense. I mean, in a sense, there's a set of functional problems that a software can solve. You can streamline the application and underwriting and all these things, but you've got a conversation at the kitchen table that's hard to replicate. Maybe Femi, can you speak to this? Like, is human in the loop necessary for your product? As students are thinking through, how do I trade off a more expensive college that perhaps is more branded and credentialed versus a different college? How do they think through those things? And is the human sort of an interim step or an inevitability?
Yeah, it's a great question. And for us, when we first started, I was very, the companies I'd built before were really in this idea of like automation to remove any human element. And then I ended up kind of coming to terms with like, there's still some things that like humans will always be able to do better than machines. And instead of using automation to replace, we should probably use automation to enhance. So for us, about 6 months ago, we kind of realized like one of the missing links that we needed was there's just some questions that, and in the States, you have 400 guidance counselors to 400 students to every one guidance counselor, and only 187 school days. And so even if a counselor was to meet every single student in the school, should be meeting twice a day and would never see them again throughout the school year. And they don't even meet all of them. And so we realized there's a lot of value in just having someone a student can talk to about anything, and ended up bringing on financial aid counselors that students can chat with any time of the day, and have found ways to automate a lot of their work. So now we're able to map one counselor to almost like 20,000 students, which is absurd compared to one counselor couldn't manage 400 students in the same school building. And what we're finding is like that number theoretically should continue, that ratio should continue getting better, just because we're finding it's always the same questions over and over again. And we're able to enhance our software offering by having like the human element give us like a feedback loop between like, what is it that students really need to feel good about this, considering it's like very scary and confusing process. And how can we build some of that interaction into software form?
Got it. That makes a lot of sense. And then maybe talk a bit, Femi, you mentioned financial services for Gen Z versus solving the how do I pay for college problem. Can you talk about some of the psychology of Gen Z, which may be different from previous generations?
Yeah, yeah. I mean, I wonder if this is true of every generation, but I think Gen Z definitely believes we're the best generation that is yet to come.
Because you are.
Um,
It's just
I think you are. I mean it. I think they're the coolest.
there's a few things that I think are really, I would think are particular to us versus other generations. People are, at least Gen Zers, one thing that we find is like they can, and excuse my language, but they can smell BS from like 1,000 miles away, and like very like radical transparency is really important to them. In fact, we actually, when we were talking about how do we make money and explaining to this to students, we copied a lot of the language that was built at Credit Karma, because there's a lot of like radical transparency in this win-win-win model. I think that's like really big. I think Gen Z, like we're going to see, and other companies that outside of the fintech space I'm really interested in is like companies that enable small businesses, like the Shopify's of the world, companies that enable creators, because I think Gen Z is like going to really be the generation of side hustles. Like we saw this in the millennial generation for sure. But Gen Z, like you have like young people spinning up a t-shirt brand and selling 1,000 t-shirts in a day through TikTok, which is like insane. And then when it comes to like their financial patterns, like similar things, it's like they just want to be told what's going on. Like they're okay with like making money with fees or whatever, but they don't like hidden fees and such, very similar to like the millennial generation before us. They're also like, when it comes to like when we look at like millennials in college and what that was like, you would have things like credit card companies setting up booths on campus and saying like, hey, I'll give you a free box of pizza if you sign up for a credit card. I don't know any Gen Zer who would fall for that. And so there's some elements of that where the bar for trust is significantly higher. But if you win that trust, they're very, very loyal. And they're able to like coalesce around that loyalty very quickly. Like we saw this with Trump's rally in Tulsa, where they were able to buy up all of the tickets through TikTok and make the rally empty. So I think like what we're finding is like bar of trust is definitely higher. People they definitely want to take things into their own hands more. And if you can really nail loyalty down with Gen Z, you'll have them for life.
Got it. Yeah, I call that the $500 pizza problem. You know, how do you buy $500 pizza? You get a free credit card for taking the pizza. That's cool, man. And that's interesting. So, you know, one thing you're sort of implying, I think, in that statement is that the psychology has changed, and therefore perhaps the willingness to pay has changed as well. Ali, how do you think that impacts the business you're in? Like, how do you need to sort of change the actual way products are marketed, sold, and monetized for a new generation?
Yeah, a couple pieces that I think Femi brought up that are super fascinating. I mean, one that you mentioned, Femi, was the side hustle. And I think that there's a whole generation of people that love helping other people. But when they thought about insurance as a profession, they thought about the sneaky car salesperson. And I think that we can actually empower a whole net new cohort of people to take on a side hustle, where if we can help them reduce the learning curve on the complexity of products, because like one of the hardest parts is, as a traditional broker, you have to create the mental model of all the underwriting guidelines, all the different products, all the different carriers. If we can use technology to help alleviate some of that pressure, maybe people can actually go back to what they love doing, which is helping other people. I mean, fundamentally, that's why I started as a financial planner. It wasn't because I loved finance, it's because I loved helping people, and this was a mechanism to help people after being a failed kinesiologist. Or I just hated seeing people injured and I wanted to help people in other ways. I think the other piece that Femi brought up that's true is the transparency component. You know, I think that this generation truly values their data in a completely different way because they understand what that means now, versus the last couple of generations. Oh yeah, they got my email password. Okay, they didn't really get it. And now, as if we think about the future of underwriting, I'll give you a core example. Like, there will be a day where we'll pick up our cell phone, hold it to our retina, and it will risk price me based on how my retina is degenerating, as an example. And so in that moment, you can give a millennial or a Gen Z a carrot or stick approach. Let me scan your eyeball every 6 months, and you may qualify for a $20 discount, but you'll never get a higher price. And effectively, you're giving that ownership of their data, control to themselves, with a choice, with an alternative. And I think our job is to break down some of these traditional barriers of opaqueness and try to actually surface up how data is leveraged, where it's used and how, for how long, by which parties. Because I fundamentally think the problem for a lot of insurance companies and financial services companies at large is we all think about data ownership the wrong way. It's not about owning the customer data, it's about the customer giving us permission to leverage the data to provide more value to them. And I think we got to reframe some of that narrative.
So that's a great point, Ali. And I've heard it from a bunch of folks. Investors love to talk about, alternative data, new models for underwriting. Is that the 10X in the industry? I mean, Ian, maybe you can weigh into it, and guys, you don't need me to prompt you. Feel free to jump in. Like, is that as good as it seems to be, or is the 10X in something more mundane like customer acquisition cost or servicing?
Yeah, I think it's a combo package. I mean, like, we'll just use a simple analogy that underwritten products take between 6 to 12 weeks. So if we can drive that down to 24 hours, we've already created, I think, a lot of 10X value right in that one workflow experience. And maybe I'll throw it to Ian. There's probably a host of other experiences that we could share collectively on that one.
Yeah, and I think, there are so many opportunities in that underwriting piece, right? Where some of these processes, it's just crazy that, the manual labor that goes into it is just mind-boggling, right? Like, if you can just reduce and eliminate 30% of that manual process and the errors that come through that manual process, then you're getting all kinds of value creation through that, right? And it's just unbelievable to see under the hood of some of these carrier clients that we're working with, just like how much of it just hasn't changed in so long, right? It's not just about, what is the advisor doing when he, or mostly he, is speaking to the consumer, but once he has all that information and he got that trust and there's an application, like, the things that go back and that happen in the background are just unbelievable. It's mind-boggling that they've been getting away with it for so long. And so, we're able to reduce significant amount of costs and errors just by helping them in that back end process, which is still very much manual and just hasn't caught up with the times at all. So there's many opportunities in the food chain. And I think, Ali and I, our businesses are mostly focused on distribution, but when you look at, the whole value chain, there are so many opportunities in the insurance world to drive significant value. And as a startup, obviously we choose to focus where we think we believe we bring the most value, but there are different startups focusing at every piece of that journey, and every one of those startups are likely providing a tremendous amount of value to the carriers, and the advisors. But traditionally, this industry has looked for a one-stop shop for all of this, and I don't think that's the way of the future, right? Like, there will be multiple companies like Finaeo and Breathe Life focusing on different pieces of the value chain, and our clients are going to be working with multiple different vendors as opposed to one or two or three. That are trying to do everything but don't do anything great.
I think when it comes to on the lending side, I can touch on when it comes to this world of like, will alternative data be the 10x lever, or like the 10x be the lever for you to build like a great fintech company? I don't think that's going to be the case. I think that stopped being the case years ago at this point. I remember a lot of our early investors kind of were in this like lending space, and they would always remind us, there's no way that you guys will ever be able to underwrite better than we can. And because whatever pieces of data you find, will find a way to replicate it as quickly as possible. And there's also there's still a lot of like gray area when it comes to alternative data. Like, what can you actually use in order to underwrite a loan? And we find a lot of the pieces that companies like even ourselves and others wanted to use aren't kosher under regulation. I think what's going to end up happening is, like, at least on the consumer fintech side, we're finding a lot of the We look at a lot of the older, more established players who kind of went after the millennial space, and you find like as in the beginning, like your economics tends to be really, really good. It's like this brand new alternative, like neobank or other product, and then as you scale, you find like your customer acquisition cost scales just as quickly. And so I think for consumer fintech, like going forward, it's going to be who's able to like have better distribution channels and ultimately lower cost of acquisition, because like even in our case, we found if we ever wanted to touch Google ads or Facebook ads, like a lot of players do, we're competing against the very banks that pay us, and the numbers never would work out.
Got it. Yeah, it is sometimes hard to separate the signal from the noise in some of these areas, but the markets are so enormous that it does feel like something in other markets might be incremental could actually be a 10x here. And related to markets, I'd love to hear from all of you. One thing that we talk a bunch about at Andreessen is how most software companies are sort of default global. If you're the Google of Canada, is going to be the Google of the US, is going to be the Google of India. But fintech tends to be default local, just because there's regulatory differences or sort of consumer psychology and preference differences. So, it's possible to have a chime of the US, a chime of Canada, a chime of England. How do you guys think about market sizing? We're here obviously to build venture scale businesses. Do you think that operating in Canada and or any specific subset of geos globally is enough, or do you think that you need to be and can be a global company?
I think that as soon as you jump on the venture bandwagon, if I can use that expression, like you're automatically shooting for the fences, and that is a choice that we as entrepreneurs make. Like you don't have to go that route. It's certainly one that we chose, and I think that I don't think you can be the type of venture-backed business that we want to be, or that our investors want us to be, by focusing on the Canadian market. So that's why we're 95% of our efforts are focused on the US market, which is definitely the biggest market in the world for what we're doing. I think I didn't mention this, but we were talking about direct to consumer versus enterprise. We started off as a direct, like we wanted to be like the life insurance brand of the future, as I like to say. And we did that for about 6 to 7 months before we realized what we thought was a much more interesting opportunity, which was to be an enabler and to work with the industry to help them transform digitally. And there are multiple reasons we did that. But one of them is mainly that, with this direction, you more easily have a global potential business, right? If you're going direct and you're going into the States, then you need licensing across all the states. And like with the type of business that we're doing, we get away with not doing that because we're fully white label, right? So our brand never appears, it's the brand of our clients. That's one of them. And Femi talked about CAC and unit economics. Like when you're going up and trying to buy AdWords or Facebook or create content to get those leads, like you're going to pour in a lot of marketing dollars, and that was not a business that we were excited about. And the other things come about too, right? Like in Europe, the perception of the insurance world is very, very different. It's a lot more positive, and consumers are actually more inclined to buy direct life insurance than they are in the US, right? In the US, it's still very, very much driven by the producers. And so things like that were things that we realized in the course of the six first months of our business. And that's why we ultimately went into the enterprise business, right? We are Duck Creek. We're not Lemonade, right? And we think that Duck Creek has a very, although the IPO took a lot longer to get there than it did for Lemonade, the business that Duck Creek built, in my view, is more interesting than the business that Lemonade built. And we're very happy from that decision. And it's when we made that decision to go towards the enterprise and enabler route that things really started really taking off for us. And so we firmly believe that was a great decision.
Yeah, good commentary on that one. And Ian, I think that one of the interesting things about our businesses and our business choices are our business models, right? Like you took a white labeled SaaS approach. We're taking a commission split approach, which means that we got to be licensed in those states. And so one of the fundamental differences for us in go-to-market is how do you time your go-to-market to your regulatory constructs, and how do you marry those two at the right time so that not only is the technology ready, the foundation on your distribution partnerships are ready, but you're actually ready to operate. And so, one of the things that our board really helped us think through was, when we want to think about a launch plan, how are we phasing out all of our regulatory work around that launch plan and make sure that we're prepared to enter the market the right way? And I believe that there's two differences for us to think about as insurtechs and fintechs in general. There's mature markets and immature markets. And I think that the go-to-market that we chose enabled us to operate in both mature markets where we can help to consolidate a supply chain, but also into launch to net new immature markets. So if you take LATAM as an example, where they don't have the maturity of a multi-layer supply chain built, but there's a great opportunity to empower entrepreneurial spirits of those cultures to then stand themselves up, become planners, and enable them with the technology to go end to end. You can solve that problem like going from a landline to a smartphone versus what we have to deal with, which is the landline to the flip phone to the smartphone in mature markets. And so I think that the choices, the stark differences in our choices on go-to-market also make us think differently about how to attack regulation and what construct of regulation we want to be touching, and ultimately what we don't want to be touching. So I think it's pretty fascinating. Early days to think through that.
Got it. But it sounds like both of you are saying that, the default is to build a global business. And it sounds like most of the things that you're learning in your first market are, can be translated to new markets as well.
I mean, for us, for sure, especially on the technology side, again, like most mature insurance markets are dealing with the same problem set. And the workflows from talking to a customer at the first touch point to underwriting a policy is a generally global consensus, which is the same across all mature markets.
Yeah, I would agree 100% with that.
Got it. Very cool. And then, Ian, you mentioned Lemonade. I mean, I'm sure we've all been sort of curious. Maybe talk to some of the high growth insurance plays that have been built over the last 5 to 7 years. I mean, it sounds like you're bearish on the direct-to-consumer model generally, but there's obviously some exceptions. I mean, maybe both of you can sort of speak to what you like or don't like about the companies that are setting precedent.
Well, I think if I look at some of the direct brands that are out there in the life space, I think what's interesting is we're seeing definitely significant traction from an investor standpoint, from an awareness standpoint. What's difficult, I find, with those models is that the cycle for life is very, very long, right? Like if the consumer is buying a product that is a term, 20 years or 30 or more, the cycle of the claim and all these different things is very, very long. And so if you look at a company like Lemonade, where the cycles are much shorter, I think it's easier to understand the long-term value that's being created, or are they attracting good risk, bad risk, all these different things. And so I think it's trickier in life versus P&C. And life is going to take longer to understand whether or not the risk that's being attracted is the type of risk that you want, because you need a balance, right? You need it to be spread out. Like there's one hypothesis, which is obviously not the case, but one could say that all the risk that they're attracting is bad risk, right? Because that's the only way they can buy it. Well, no, we're sure that we all believe that's not the case, but it could be. Excuse me, it could be the case. Hold on.
He's a Lemonade investor. He's upset.
Yeah, exactly. Sorry, hold on a second.
The joys of a remote world. Maybe I can pick up until Ian comes back. But yeah, I think that there's some really interesting nuances. Oh, he's back. That was a quick one.
Sorry about that. This is Jackson.
Keep going, Ian. It's on you.
Oh, I was just saying that, obviously we don't believe that they're attracting 100% of negative risk, but only time will tell whether the risk they're attracting is good or bad. And that's challenging for the life industry. And I think we'll know sooner with the P&C direct brands out there.
It's a great point. You agree?
Yeah, I think statistically relevant amount of people unfortunately have to die. Like that's the ultimate truth of life insurance. It kind of sucks to know, but those models you can't actually prove or disprove until that happens. I think that there's two other things to consider as you look at valuation multiples of these large companies, which is one is, are they marketplace businesses where they're being looked at on premium, or are they infrastructure businesses that they're being looked at as SaaS? And I think that there's two things to consider there. What is actually driving the defensibility of the business model versus what is driving the economics of the business model? So if I give kind of our lens at that, we think that we know for a fact our business model is a marketplace. So we think about gross written premium as the #1 metric of our business. However, the defensibility of our business model is around owning the value of the supply chain or the pipes. And once you've cemented yourself as the person helping insurers downstream distribute, you own that highway. It's a very immovable object because insurance companies are reliant on your pipeline to sell. So there's this there's tangible business value at the top of the house around the marketplace. And then there's this underlying moat that also has to have some attribution, which I actually feel like that's the sticky layer of the actual business value at scale. And I'm hoping and hopeful to see more companies kind of set precedent there of these kind of hybrid models, because I think it's fairly new for at least our space of insurance.
Yeah, it makes sense. Why pick when you can have a bit of both?
And that's a really good point, Ali, because we're looked at by investors as a SaaS, right? And so the metrics that they're looking at is recurring revenue, and it's a very different lens. And it's I think it was very well articulated where it's two different approaches, two different models for an investor when they look at the model. And we're looking at signing 3, 4, 10-year contracts. And that's a different mechanism than a gross written premium, right? It's very, very different models.
Absolutely. Yeah. And hey, why take risk when you don't have to? Femi, maybe you can speak to this a little bit, sort of touching on the public market point. A lot of the incumbent banks pulled out of the student market post Dodd-Frank because you couldn't sell the $500 pizzas anymore. I mean, what do you think banks and investors generally are getting wrong about the market you're going after?
I'm sorry, could you say that one last piece? What do I think banks and investors are?
I had a whole monologue, Femi. What do you think investors and banks are getting wrong about the market you're going after?
Great question. Now you can tell investors all of my thoughts from every meeting. I think a few things that we found when we look at players in the consumer fintech space that have kind of been winners in their space, whether it's Dave or Simple at the time, or a lot of these neobanks. I think a lot of investors think those winners will still be the same winners in the Gen Z space, which is a fair thing to think. I think those that what we find is part of what made those companies successful doesn't necessarily apply to our generation. A lot of it's you have a lot of millennials have really horrible experiences with traditional banks, and that's where a neobank could come in and say, hey, we're a better experience, we're no fee, we're all this. Gen Z doesn't really have that. For traditional banks have gotten way better, knowing that fintechs are coming to eat their lunch a bit. And so a lot of those plays, I don't think are actually going to be the winners in our generation. I think we're going to have to really rethink what fintech will look like. Specifically, you can't really just come in with a new neobank and win Gen Z. You kind of have to actually solve their own pains. And the biggest pain that they have in regards to the financial world is paying for college today. I think other things that they get wrong. I think it's. I feel like it's so much, and I'm trying to figure out which I want to go after first. I think this has become less and less the case. Before it was Gen Z is such little buying power that you can't really make any money off of them, and that's objectively wrong. Gen Z spends $200-300 billion a year on stuff, It's like everything from movie tickets to Spotify subscriptions to everything. So I think that's been a bit debunked, and we have a lot of investors now becoming more and more interested in the Gen Z space. I think one case specific to us is even like this, specific in the States, like the student loan crisis. It's like there's a lot of headlines around this, but a lot of people don't actually understand the underlying factors that's going on. When we talk about like the student loan crisis, a lot of it is actually 40% of students who start college don't end up graduating, and so they end up taking a year or 2 years of debt on their books, and then have no degree, and they're in a worse off spot than they were if they hadn't just gone to college. So I think there's stuff like that like we kind of have to educate people on. I'd also say like, it's kind of just like, how do you attract and acquire like Facebooks and Instagrams and Twitters of the world? So like you'll always be able to use those ad platforms to attract Gen Z into fintech. But I think like a lot of players are having to really think differently. Like we saw Step, the neobank that did a collaboration with Charlie D'Amelio, who's one of the largest TikTokers in the world. And you're gonna have to go closer to Gen Z and really understand their like consumer psychology to actually build a category defining company in the space. And kind of, I think the playbook that worked even in the last 5 to 7 years is going to start falling apart when it comes to our generation. So I think that's like some of the top things that come to mind. Sorry. But yeah, I'm sure there's quite a lot of others.
Got it. Very cool. And then maybe if we can just nerd out for 1 second, and then we'd love to hear questions from the group. Folks have them on video. So Ollie, Ian, one thing that I learned about relatively recently actually was annuities. Seems like nobody uses them anymore. You know, life insurance being where you pay premiums and then your family gets a lump sum when you die, and annuities, of course, being the inverse of that. Do you think that those products are just going to be, you know, are they going to be relegated to history, or is there a chance that annuities could be used in a new and interesting way? And maybe explain them too for a moment, just for the benefit of everyone.
Yeah, sure. So annuities have a two-sided component. You have an investment component and an insurance component, and a lot of people in the higher net worth category use them as tax strategies. So like broadly speaking, I encourage you not to go too far into the annuity rabbit hole unless you want to sleep well at night. I think there's a couple of things that are interesting with the annuity. So first is digitization of annuity products, which I know Ian and his team are working on, is quite different than doing term insurance. Like there's a whole nother step lock function around getting from term insurance to annuities. And I think what you've seen is just a lot of investment on low-hanging fruit, because those are still at the small mid-market. A bulk of sales velocity happens in those earlier product segments. And so I think that there's a whole new opportunity in annuities. One of the challenges for consumers is understanding the variations across investment strategies at different insurance companies. So there's something called an illustration tool where brokers who are selling annuity products have to get a customer to basically sign off on the projections of how the investment component of annuities will work. And there's never been any standardization around this. So I think that there's some reframe opportunity for consumer education around how annuities are actually manufactured and function. And also I'd like to see the insurance companies allow consumers to take more portfolio control over annuities. I think one of the challenges, again, for the next generation is that they want to have more agency over their financial services. And so if you're tied to a portfolio that you have completely zero control over, I think that that's counterintuitive to what consumers of next generation are looking for. So I'd love to see kind of some innovation around the hybrid ETF type robo wealth models, and then blending that with some of the traditional annuity products. And Ian, I'm sure you can talk more specifically around that.
Very interesting.
Yeah, I was just going to say for sure that there hasn't been a lot of innovation on annuities in general. It still remains, from what we're seeing with our potential clients, as a huge market and something that they're trying to push. And obviously, we're trying to encourage them to bring some of that innovation. You know, we've started doing a bit of it. It hasn't been a huge focus, but just the scale of that market is gigantic, right? And so I think there is a lot of misconception. There's a lot of lack of clarity around how they work and what is, you know, why you should do it. And as Ali said, like the rabbit hole. So I think we need to push the industry forward to rethink how they approach annuities and what it actually means and how we can distribute it, if we should distribute it or continue to distribute it. So this is something that, you know, we are less focused on product innovation, although we do want our clients to think about it. But our tagline is "We power, you insure," and so our goal is to make the delivery of these products as seamless and as frictionless as possible. And we will definitely entertain the conversation and see whether or not we want to distribute some of these products. But we have definitely turned down multiple different types of products that our clients wanted us to distribute through our platform for a variety of reasons, and that may happen with in the future as well, based on the products that they're looking to sell.
Cool. Anish, one idea that I think is like somebody ran across at a conference once that stuck with me was this concept around a micro annuity marketplace, where consumers could again design and create their investment construct as a micro investor, instead of like the traditional annuities don't really start until you have 20, 30, 50, $100,000 a year to invest into that type of a product at a traditional insurer. And I think creating these micro investment vehicles that can be owned and controlled, then like reinsured almost by another entity that allow insurance to manifest out of a portfolio strategy. I think that's really, really hyper cool.
Yeah, there's a lot there. It's really rich, actually, because you might imagine, Femi's generation might decide that they want to actually do a sabbatical at age 40, and that's
sure.
like, pre-retirement, retirement experience, and how do products like annuities support that?
I thought you should all know that this is why Jackson was barking. The doorbell rang, and I just got this in the mail from the 100th. My son just literally gave it to me. He's like, "Oh, look what you got."
Sorry to interrupt you during your conversation, but happy that you have C100 swag.
There we go. Perfect timing.
We got 2 audience questions. We got 5 minutes, so let's quickly cover them. So maybe I'll do the second first. So from my friend Kareem. What's up, Kareem? Fintechs have to deal with huge regulatory burdens compared to other industries. How do you manage these regulatory requirements across geographies?
Very painfully.
Yeah.
No, I mean, it's an inconvenient truth. I think it's something that we've dealt with since day one. And our first client was a bank that had an insurance arm. And so they really put us through the grinder, both from all kinds of regulatory perspectives and certifications and this and that. And so, we have people that are dedicated that, work on that type of stuff and make sure that we are abiding by all the rules and that we're taking data privacy seriously, and certifications, all these different things. Like there are people that do just that in our team, and it's a lot of heavy lifting for a team of 40 people. Obviously way more burden than we'd want it to be, but we don't have a choice. We have to do it. It's part of our requirement. So it's not fun, but we get it done.
Not fun, but get it done. That's a good tagline. Well, I think there's a couple of pieces. Like, one is that this is one of those areas that you absolutely need founder market fit. Like, I just don't feel like you can wake up coming out of school and understand the dynamic complexities of regulation and insurance. And so, on the call today is Donald Chu, my co-founder, but also our chief compliance officer. And so having thought through at the earliest days what our end state business model was going to be and architecting the team with the right skill set to understand those nuances, that's one. The second is working ahead of the problem. So again, thinking about, we wanted to launch in the States in 2021, starting our regulatory journey in 2019 to set the foundation so that now we're a 49 state licensed and ready to hit the ground running once we're there without any constraints or bottlenecks. We had to do a bunch of research on what states would follow what regulatory construct versus what wouldn't, and how you don't want to touch New York until the end of the day, like stuff like that unless you've kind of gone through it, you probably don't know. And then the other kind of consideration is I think truly embracing regulation. Like, let's not look at it as a thorn in our side. Let's look at it as a strategic advantage and angle. So one of the things in Canada that we did early is we became nominated to represent a regulatory body called Advocates, which is the broker's voice in the market, and we sit on their technology task force. That's now catapulted us to an opportunity to apply at the regulatory table for the country to help craft next generation regulation around data standards. So we thought about that at the earliest days as like, what would we need to leverage regulation for that we can create a strategic moat around it, rather than something we just hate to deal with every day. Now, Donald has a different tactical answer probably, because unfortunately he's got to deal with most of it, but I think you can actually use it as a strategic advantage and a bit of a fence around your business model.
as a marketing tool too, right? It's just like we're ready for it, whatever market that you're looking to go into. Yeah.
Yep.
Got it. Cool. Okay, we've got too many questions now, not enough time. I wish I'd pulled for this earlier. But Femi, maybe I'll give you the last word here. Talk about distribution. How are you getting customers? 150,000 is a really significant number. I mean, what's your approach there, and how do you continue?
Yeah, super great question. For us, the way we've looked at it is we're actually in a much, I guess, sweeter spot than most fintechs because we give money away for free. And so it's like not too difficult, kind of thing like PayPal days where you're giving $5 away to get people to sign up. And other fintechs have like adopted similar strategies. So first, hasn't been as much of a concern. We also have a lot of really interesting, because we cover all sources of financial aid. We have a few interesting like viral loops, you could say, that we've been able to productize. Like a lot of aid applications will require counselors input, and then we've built tools for the counselor to come in. So student will type in their counselor email, ping the counselor, get them on the platform, and then use that touch point for the counselor to share the platform with more students at their school. And for us, the way we've looked at it is like, this problem is so painful. And part of why, like when I initially dropped out, I remember the first thing I had ever told one of our earliest investors was I wanted to create a bank. And I remember just learning how the acquisition costs just become so absurd when you go that route first. So solving the most painful part of the financial world for students, and then using that touch point to like say, okay, cool, now use other financial products with through us, has enabled us to like acquire students through another medium, solve a really strong pain for them, build a lot of loyalty and trust, and then parlay that trust into other products in the future.
That's great. Thanks, Femi. And last question, most important one, did Christine say yes?
Yes, Christine did say
Oh,
yes.
great way to end.
Who could say no to that smile? Are you kidding me?
Right?
Great.
Thank you guys so much, Ian, Ali, Femi. I really appreciate you guys joining me today. And thank you for everyone who listened.
Anish, thank you. This was great, super thoughtful. Love all these founders. It was, I love this discussion. Thank you for the questions that you put together. Femi, Ali, Ian, thank you so much for spending the time and sharing about your wisdom. You all know to connect with anyone after the session, go to the 48-hour Slack space. The next upcoming panels, Marketplaces, led by our one and only co-founder, Anthony Lee of the C100. And GP at Altos Ventures, and B2B SaaS, moderated by Arif Jan Mohammed at Lightspeed. If you do want to go to the main stage, I was told, I just put that in the link. Hopefully you see it and hopefully it works and you can continue the conversation. Don't forget Harley Finkelstein from Shopify, 4:30 Pacific, 7:30 Eastern, happy hour. I think he's DJing. It's going to be fun. Thank you again on behalf of the C100. We're going to wrap on this.
Awesome. Thank you.
Thanks for having us.
See ya. See you, Kareem. Bye.